Hey everyone, and welcome to The Explainer. I am so glad you're tuning in today because we're about to unpack something absolutely fascinating. We're going to connect the dots between those high-level geopolitical tensions you constantly see in the headlines and what they actually mean for your personal wallet and everyday life. So let's just dive right in. $6 trillion. Let that number sink in for a second. That is a staggering amount of money. And it's not just some random statistic. That represents the massive amount of global capital, trade, and economic output that is currently at risk or is literally being redirected right now. This isn't some distant future scenario. It is happening today. The entire global economy is undergoing a massive seismic shift, and this number really captures the sheer scale of what we call the financial fragmentation crisis. So what exactly is financial fragmentation? Well, think of the global economy kind of like a computer's operating system. For decades now, the whole world has essentially been running on the exact same unified OS. Money, investments, and trade could just flow smoothly from one country to another. But fragmentation happens when that single system breaks apart into separate, isolated blocks. Basically, we are moving away from one open global economy and heading straight toward incompatible, competing walled gardens. To really understand this, we have to look at the contrast. In the old system, capital just flowed freely to wherever it was most efficient. We had shared banking, unified payment networks. It was practically seamless. But today's new reality, it's vastly different. Thanks to rising geopolitical tensions and trade disputes, we're now dealing with restricted foreign investments, isolated financial blocks, and completely split payment systems. The free flow of money is rapidly being replaced by heavy, fortified borders. Section 1. Why the world is splitting. Let's look at the big macro drivers pushing governments to divide the world up like this. It really boils down to four main goals. First up, protecting national security. Governments are clamping down because they want to stop foreign adversaries from controlling critical infrastructure, high-tech firms, or sensitive citizen data. Second, reducing the risk of financial weaponization. Nations are terrified of waking up one day and finding themselves cut off from global commerce by foreign sanctions, so they're building backup networks. Third, securing supply chains. You've probably heard the buzzword friendshoring. That's policymakers trying to bring manufacturing back home, or at least moving it strictly to allied, friendly nations. And fourth, achieving economic autonomy. A lot of countries are actively trying to break their heavy reliance on a single dominant foreign currency, specifically the US dollar, when they settle international trade. Section 2. The mechanics of financial divorce. Okay, let's look under the hood. How do you actually pull an integrated global economy apart? Think of these mechanisms like tectonic plates shifting beneath the surface. First, you have capital controls. Governments pass strict laws limiting how much foreign currency can enter or leave, which instantly restricts your ability to move investment money across borders. Next, sanctions and asset freezes. These are aggressive legal orders that outright block access to foreign central bank reserves or corporate assets. Third, splitting payment infrastructure. Countries are literally building independent alternatives to established systems like SWIFT, forcing cross-border money to navigate totally separate networks. And finally, investment screening. Regulators are scrutinizing and often blocking foreign buyouts of domestic companies, especially in sensitive industries like AI, microchips, and green energy. Now, a change this massive doesn't just happen overnight. It's a chronological domino effect. It almost always kicks off with step 1, geopolitical friction. A political conflict or trade dispute flares up. That immediately triggers step 2, defensive policy formulation, like a government restricting high-tech exports. Right on cue, we get step 3, retaliatory measures, where the affected nation might freeze foreign investments in response. Then comes step 4, corporate realignment. Businesses look at the landscape, realize the political risks are just way too high, and they start relocating their factories to safer regions. And finally, we hit step 5, systemic lock-in. Once these local trade agreements and alternative payment systems are fully built and mature, the division becomes somewhat permanent. Going back to a unified market from there is incredibly difficult. Section 3, the global chain reaction. Trace this impact chain with me, because this is where a political decision devolves into real-world economic pain. Step 1, sanctions and bans get slapped on. That leads to step 2, divided capital pools, meaning investors are legally blocked from certain foreign markets. Because the funding sources dry up, we hit step 3. Businesses suddenly face much higher borrowing costs. That directly forces step 4, huge efficiency drops. Companies actually have to duplicate their factories and supply networks across different regions just to avoid political disruptions. And ultimately, that entire mess leads to step 5. Global economic output decreases, which fuels higher structural inflation worldwide. To put that into perspective, estimates from the International Monetary Fund warn that deep financial fragmentation could cause a permanent 7% reduction in global economic output. Now, 7% might sound kind of small when you just say it out loud, but in reality, we are talking about wiping literally trillions of dollars out of the global economy. It is a massive structural hit to global wealth. Section 4. What this means for you. Because that's the ultimate question, right? How does a divided world actually affect your wallet? Let's connect the dots between those high-level geopolitical squabbles and your personal bank account. Time for a quick wallet check. Here are the very real micro impacts you're going to feel. First, higher consumer prices. Remember those duplicated factories we just talked about? When companies can't manufacture goods wherever it's cheapest, their production costs skyrocket, and they pass those costs right on to you, meaning you pay more for everyday items, electronics, and cars. Second, reduced investment returns. With capital trapped in certain blocks, diversifying your portfolio gets much harder, which can mean lower returns for your retirement accounts. Third, increased corporate compliance cost. Companies are burning cash hiring massive legal teams just to navigate competing sanction lists, which eats right into their profitability. And finally, localization of technology. The tech world is totally splitting. A digital wallet or a web service that works flawlessly in your home country might suddenly be completely blocked or non-functional when you travel to another block. And here's another thing to keep in mind. Fragmented markets are, by definition, smaller markets. And smaller markets are a lot less liquid. It's like throwing a rock into a puddle instead of an ocean. Because of this, even small economic shocks can cause massive, sudden swings in stock values and currency exchange rates. For you, that means dramatically increased market volatility for your investments. The safety net of a massive, unified global liquidity pool is just gone. Which brings up a really serious question. If our markets are smaller, more volatile, and completely walled off from each other, what happens when the next global crisis hits? The systemic limitations we face in a fragmented world are deeply concerning. Without a unified system, we have severely reduced crisis cohesion. Think about it. If a major financial crash happens tomorrow, divided nations will find it incredibly difficult, maybe even impossible, to coordinate bank bailouts or stabilize currencies the way they did back in 2008. On top of that, it creates massively inefficient climate financing. Tackling something like climate change requires trillions of dollars to move smoothly across borders. Financial fragmentation literally blocks this vital capital from ever reaching the developing nations that desperately need funding for green energy. I want to leave you with this final, provocative thought to chew on. How can we fund global climate initiatives or manage the next financial crisis in a world permanently divided by walled gardens? It's a huge challenge, and it's one we all have to face as investors, consumers, and citizens. Because the costs of a fragmented world aren't just measured in the trillions of dollars lost. They're measured in our inability to cooperate when we need it most. Thank you so much for joining me on this explainer. Keep learning, keep questioning, and I will see you next time.